So to kick us off, clearly the big story in town, the big issue at the moment is inflation and the high levels of growth in prices that we've seen over the last over the course of the calendar year in 2022. So as you know, inflation should in normal times be tracking around about 2%. We were forecasting that it would rise when we did our forecast this time last year, but clearly there's been a spike in inflation relative to what most people would have forecast as a result of a combination of factors, most notably the war in Ukraine leading through to an energy price spike, but also ongoing challenges and disruptions in supply chains and international markets and pressures in the labour market that have put upward pressure on prices. And our latest forecasts were predicting that inflation would peak around about now or into early 2023 at above 10% and then start to come down quite quickly through the remainder of this year and into next year. But the crucial thing is that the price level has changed, and that has important implications both for the economy, both for households in terms of their living standards, and also government budgets too. So the effects of inflation are quite stark. They've been something that we haven't really dealt with or had to wrestle with as policymakers for 40 years, and that will have quite a significant impact through our economy. As I said, the three key things that we're looking at in terms of the impacts of inflation are looking at what's happening to household incomes, what's happening to the overall outlook for the economy, and then what's happening to the pressure on government budgets. So picking up on the first one of these, in terms of what's happening to disposable income. So like most forecasters, and consistent with the forecast of the UK as a whole, we're projecting that there'll be a significant sharp drop in real household disposable income over the course of the next year. And that's in effect because wages and earnings are not going to keep up with the growth rate in prices, and therefore all of us are going to be worse off as a result of the spike in inflation. And our modelling, the projections that we published in December, have real disposable income in Scotland falling at the fastest rate since we started collecting this data back in 1998, so about 25 years. And this effect will be consistent across the income distribution, so everyone will feel the pinch of higher price inflation feeding through to erosion of living standards. But we do know that people in the lower end of the income distribution face in some ways the biggest squeeze, in the sense that they typically, as what economists would say, have the less discretionary income in order to offset these additional pressures. So in particular in things like food and energy price inflation feeding through to a relatively big squeeze for people, particularly in the lower end of the income distribution. As earnings start to recover, real household disposable income will start to pick up again, but it will take time for real disposable income to recover back to where it was pre-pandemic. And the effects of this cost of living crisis will be particularly felt just now and over the next few months, but they'll continue to have a legacy effect through for the next couple of years. So the one big theme that we talk about in our report is this effect onto real household income. But of course, that then has a broader macroeconomic effect, leading to a slowdown in the economy, both in terms of putting up costs for businesses, but also reducing consumer expenditure, but also as a result of the Bank of England responding to this inflationary pressure by increasing interest rates, will all lead to an easing in the rate of growth in the economy. Now, the exact timing of when the economy enters recession, how long that recession will be, and how deep it will be, is subject to a degree of uncertainty. Our broad assessment is that we think that the economy is already in technical recession, but it's likely to be a relatively modest recession over the course of this year, but potentially be relatively long-lasting, and that's the legacy effects of inflation feeding through over time. As I said, there'll be bumps along the way, so there might be some times when growth is very close to zero or even slightly positive, but that overall trend of a relatively downturn and a relatively weak period of economic activity is likely to hold for the next couple of years. How do we fare relative to the other major forecasters at this particular point in time, and how do we fare to the UK? This table in our report essentially compares our most recent forecasts with some of the other big forecasters going around at the time. So for Scotland, we're slightly more pessimistic for 2023 than the latest Fraser Allender forecast. I should caution, though, that their forecast was done back in October, and they haven't yet published their Q4 forecast for 2022, and I believe that they'll do that in the next month or so. So that comparison is subject to a degree of challenge in terms of comparability because of our more recent forecast. But if you compare us to the rest of the UK, we're broadly in line with the main official forecasters, both the OBR and the Bank of England, ever so slightly less recession in our forecast compared to the OBR and the Bank of England for the UK as a whole. I would caution that we don't really see too much radical difference between relative performance between Scotland and the rest of the UK through this downturn. There are some possibilities that might suggest that the peak to trough might be slightly less in Scotland. Combination of things like spike in energy prices feeding through to growth in earnings and employment in the northeast in oil and gas. Also, Scotland slightly less exposed in terms of mortgage indebtedness to impacts of interest rates feeding through. But broadly, overall, we don't see too much material effect to suggest that Scotland is likely to have a radical different path over the short term compared to the UK as a whole. Looking forward, in terms of the relative performance between Scotland and the UK, we are continuing to forecast that Scotland will have a relative growth gap compared to the UK, but that's subject to a couple of important caveats. So firstly, if you look at our growth gap compared to the UK, since 2010 up to the pre-pandemic period, that gap was around about 0.5 percentage points, as shown by that yellow line there. And we're forecasting for the next 5 years that that's broadly the outlook that we think will happen in Scotland. But the caveats there, a key element of that is what's happening to Scotland's demographics. And if you adjust for population, so not looking at the totality of the economy, but GDP per head, then that growth gap is projected to narrow down to about 0.25 percentage points. And then if you adjust even for those that are economically active, so you adjust for the age profile of our population, that gap shrinks even more to essentially being a very small 0.1 percentage points. And the ongoing differences for that link through to assumptions that we've made around participation, but also crucially productivity and the ongoing challenges that both Scotland and the UK face there. So we do forecast a relative growth gap with the UK, but crucially, the importance of population is being a key driver of that. And one thing just to flag is that in March, we'll be publishing our first fiscal sustainability report, where we will be looking at issues of demographics and the age profile of Scotland in a much more in-depth way in terms of how that feeds through to fiscal sustainability and essentially the long-term pressures on Scotland's budget and how issues such as demographics feed through to that over time. So population demographics is maybe something that we'll pick up in the Q&A, but it's certainly something that we're going to be looking at in much more depth in the months and years to come. So that's our broad assessment of where we think the Scottish economy is at the moment. Obviously, we get updated information on almost on a daily basis about what's happening in the UK and the Scottish economies. And so far, there's nothing that is really telling us that assessment has materially changed. And the downturn that we're projecting is pretty much in line with our expectations. So that's the overall economic outlook. What do we think is happening in terms of the tax and the funding choices that the government have made? So alongside the budget, we publish projections for what we think the Scottish Government will raise in terms of taxation, and we also model the potential income generation from government tax policy changes. There was a number of tax policy announcements through the budget. So there was changes to some elements of business rates, particularly some modifications on the small business bonus. There was a new increase in the additional dwellings supplement that the government announced. And obviously announcements around council tax, which we don't yet know the policy choices of local government, but the broad policy assumption by the Scottish Government that local authorities are essentially free to set their council tax rates as they choose to wish for the forthcoming financial year. So the big policy, the big area where the government do have control over taxation is around income tax. And the changes that the government are making to income tax are again adding to that slight divergence we're beginning to see between Scotland and the rest of the UK in terms of how the Scottish government are taxing particularly higher earners relative to the rest of the UK. So as you'll recall, in recent years, the Scottish government has been freezing thresholds at a lower rate than the rest of the UK. So essentially, more people in Scotland are moving into higher tax bands, and that's raising revenues. And then at the same time, adding some modifications to tax rates in order to seek to raise revenues. And that broad theme was continued again in the announcements that the government made in December. So we had the increase in the higher rate threshold going up from 41 pence to 42 pence. In the UK, it's 40 pence. And then the top rate increasing from 46 pence to 47 pence compared to 45 pence elsewhere in the UK. The basic rate and the starter rate were again frozen. And then, like the UK government announcement, the top rate threshold of tax was reduced from 150,000 to around about 125,000. Now, in total, we estimate that once you model these changes and account for behavioural effects, so that's people adjusting their behaviours in response to these changes in taxation, we estimate that that will raise about £129 million for the Scottish Government next year, rising to about £162 million by 2026, 2027. As I said, one of the interesting things is this different strategy by the Scottish Government compared to the UK Government in terms of the use of thresholds in order to try and raise additional revenues. And if you look at the growth in higher rate taxpayers compared to the rest of the UK, there has been quite a divergence over the last few years in terms of the growing number of higher rate taxpayers in Scotland vis-a-vis the UK. So this chart here just shows you the growth in higher rate taxpayers, the green line by showcasing Scotland, and the yellow line are UK starting in 2016, 2017, when the Scottish Government was given these income tax powers. And the yellow line shows that over that time period, up to the most recent year that we have data available in 2020, 2021, the number of higher rate taxpayers in the UK fell by about 10%. In contrast, it grew in Scotland by over 20%. And increasingly, we're seeing a growing number of taxpayers in Scotland moving into the higher rate tax band. So it's around about 18.5% of all income taxpayers are now paying into the higher rate band in Scotland, compared to about 11.5% in the rest of the UK. So a growing number of people moving into paying more tax as their earnings go up. And that's an effort by the government to increase revenues. So that's the major policy changes. One of the things the two things that I think are really important in terms of understanding the context of tax policy changes is looking firstly at what we call the income tax net position, and then looking at the reconciliations, and that's essentially the variations between our forecasts and outturn data. So turning first to the income tax net position, then you'll recall that the way this framework works is that the Scottish Government essentially chooses to set its own income tax policies, and that then feeds through, along with the growth in the economy, to a certain amount of income taxes that are being collected in Scotland. And then there's an equivalent block grant adjustment, which is essentially reducing the block grant by the equivalent growth in income tax revenues in the rest of the UK. And if the difference between the two is positive, then essentially the Scottish Government is better off as a result of this income tax devolution. If it's negative, then money is essentially being deducted relative to what would have happened if only the Barnett formula was in place. So there's two key elements to think about here. One is the tax policy choices of the government, and secondly is the relative economic performance of the Scottish economy compared to the rest of the UK, because clearly that net tax position can improve either because the Scottish Government is choosing to raise more revenue, or it can improve because the Scottish economy is doing better than the rest of the UK. So a couple of important lines to have a look at here. The first line is this solid purple line here, which essentially is what we call the illustrative policy only line. And that essentially is saying that if the Scottish economy and the UK economy were growing at the same rate, so employment and earnings were the same, then this would essentially be how much money, how much revenue the Scottish Government could expect to raise simply from its tax policy choices. Okay, so it isolates only the tax policy choices. And we estimate that in 2024, if Scottish economy and the UK economy had been performing at the same rates, then that would be expected to, the tax policy choice of the government would be expected to raise about £1 billion. Okay, and that's what that solid line says there. What the other lines are doing is showing you what was actually raised and then what we're forecasting is likely to be raised in the years to come. So if you take the green line, so that's our most recent forecast, then we're forecasting that in 2024, the net tax position will be around about £300 million. So the Scottish budget will be better off to the tune of £300 million relative to what it would have been had tax devolution essentially not gone ahead. That's clearly less than the £1 billion that would be expected to raise from the policy-only scenario. And the reason for that is that Scotland's economy over a sustained period of time has had slower earnings growth and slower employment growth compared to the UK as a whole. And that's led to a gap between that policy simulation, that scenario where if the economy performed just at the same rate, relative to the actual projected outcome, because of that weaker economic performance. So that is almost on the downside, the negative in that context. On the upside, it has improved. So when we made our forecast this time last year, and we think the net tax position is now more positive than it was. I should say there's an important couple of caveats with that. Firstly, that this comes through us forecasting a slightly more optimistic position on earnings and employment growth compared to the OBR. Should the OBR change their forecast, or should we change our forecast, then that will change the net tax position. And to give you a rough idea, about a percentage point change in earnings in Scotland, so we were to change our forecast earnings by around about a percentage point, that would change the net tax position by around about £250 million. So quite a significant potential for variability here in a net tax position. And that's one of the things that I think we're getting a better handle of in Scotland with this budget process, is that relatively small and modest changes in economic forecasts or in terms of economic outturns can have quite significant impacts on these things such as the net tax position and the funds that the government have in place. So the second element is I want to talk to you about is the reconciliations. And recall what happens with the reconciliations is that we make a forecast for income tax revenues for the year ahead. And then we get the outturn data for how much was actually collected from income tax revenues about 18 months after the end of the financial year. And at that point, a reconciliation is then made. So if the outturn data turns out to be better than what we forecast, then the reconciliation is positive. If the outturn data is weaker than we forecast, then the reconciliation is negative. And of course, it's not just our forecasts that matter here, it's the OBR's forecasts that matter too, and how they interact with the block grant adjustment. And these are the reconciliations that we've had so far, and the reconciliations that we're forecasting, at least in the current data, for the next couple of years. And then the good news is that we are likely to have, well, we forecast and delivered the first positive reconciliation for 2024 of about £50 million. So in other words, the outturn data has been better than what we were forecasting. The relative outturn data has been better than what we were forecasting in the OBR, to the tune of £50 million, which will be added into the budget for 2024. But we're still forecasting on current projections a very significant negative reconciliation coming through for 2025 of over 700 million. And we might pick this up in the Q&A, but for those of you who recall back in when the forecasts were made for 2022, that was a time of the COVID, and it was an issue about timing of projections between ourselves and the OBR, and we cautioned that the optimistic outlook for the net tax position for Scotland at that time was likely to be an overestimate, and that in part explains that negative reconciliation that we still think is coming on stream further down the line. And the government will have to think about how they plan for that, and they already are thinking about how they plan for that if that comes to fruition. So that's some key points on tax. What about on the overall funding position for the Scottish government? So, as you know, the budget process is now more complicated. There's more additional elements being added in and taken away from the resource funding allocation on any given basis. The outturn, or the actual data we have for 2023, round about £43.3 billion going to be spent in the current financial year. And for next year, added on top of that, will be about 1.3 billion of block grant, and then additional net tax position. So that's the additional tax rates and revenues that the government are raising from their tax policy choices, adding about another 500 million on top of that. And then you've got additional funding flowing through the Social Security BGAs, adding to the budget as well. So in total, once you put all the adjustments in and you make all the positive adjustment add-ons and all the negative add-ons, then we estimate that the totality of the resource budget will rise by about 1.7 billion in nominal terms between this year and next year. However, coming back to the point we had about inflation and the debilitating impact of inflation, then we think that the real terms increase will only be about £279 million between this year and next year. And of course, within individual portfolios, when you've got increasing pressures on things like energy costs for public service delivery and increased pay awards, then the challenges within portfolios will be particularly acute as they too deal with the pressures of high inflation. So the overall budget outlook in real terms looks exceptionally continues to be exceptionally challenging. On the capital budget outlook, the nominal capital budget outlook is projected to fall over the next 5 years. And when you adjust for inflation, it's projected to fall even further. One caution I would say about this is that capital funding outlook is likely to be, in real terms, is likely to be slightly too positive in that context. We use something called a GDP deflator to capture inflation rates, because that's the consistent approach that we can use year on year. But as you know, and anyone who's been doing construction work or involved in that in recent times, you'll know that the prices of many construction activities growing much faster than the average inflation rate more broadly in the economy. So the capital funding outlook is likely to be particularly challenging and perhaps even more challenging than our projections here are suggesting when you use the deflator. So turning finally to Social Security and what's happening in that context, you'll recall that the Scottish Government is gradually taking on additional responsibilities for Social Security, in part dealing with new transfers of powers that are coming from Westminster, so replacing things like disability payments for adults and children with new benefits that are being rolled out across Scotland, but also creating and establishing new benefits in Scotland that are unique to Scotland, such as the Scottish Child Payment. And we think that in total, Scottish Social Security payments will amount to about £5.2 billion next year. That's up from about £3.6 billion last year. So an increasing commitment coming through here. And they will rise to about £7.3 billion by the end of our forecast period. Now, there are a number of things that are quite important to understand about this, about what's driving this increase. So the first thing that's driving this increase is what's happening to inflation. So most working age benefits are uprated in line with inflation rates, usually in September. So higher inflation leads to higher uplift in terms of these rates that then feed through to the totality of what's being spent on Social Security. And you see here the shaded lines here, the kind of black and grey lines here are essentially showing what we were thinking inflation would add to these Social Security payments this in 2021. The green is the additional element coming through the spike in inflation and the higher rates of inflation that we've seen in recent times. And in totality, we think that adds about £1 billion on to the Scottish Government Social Security commitments by 2027. Now, an important point about that is that provided that these are benefits that are being rolled out to replace the benefits that exist in the rest of the UK, then provided that the rest of the UK benefits also rise with inflation, the Scottish Government will get additional funds flowing in pay for these additional commitments because of additional money flowing through the block grant adjustments. However, anything that the Scottish Government is adding to, so that's encouraging potentially more people to take up these benefits or higher payments within that, that will add additional pressure relative to the flow of funding that's coming through to the Scottish budget. So that's one element that's driving the increase in social security, which is inflation. The final element are our projections about the commitments that the government are making in this context here. As I said, on the benefits that are being transferred, the UK government is transferring year on year an equivalent amount of money to deliver broadly the same benefit support as is taking place in the rest of the UK. If the Scottish Government choose to adopt a different approach to benefits, such as trying to encourage take-up, average higher payments, different ways of assessing conditions, etc., that are perhaps more inclusive and less inquisitive, and that leads to higher take-up, then that will lead to higher payments relative to the amount of money that the Scottish Government is being allocated from the UK Government. And that's given there by that top line there. So we think that that will add about an extra £200 million in 2024. And as all of the various benefits are rolled out, that will rise up to nearly £800 million by 2027, 2028. There are some significant caveats and uncertainties about that, particularly around how people take up benefits and what the levels of benefit take up is, but also in terms of how successful government policy will be in securing the change in delivery of social security that they're hoping for. So that's the first line. And then the second line is the commitments that the Scottish Government is making in social security payments where there is no equivalent transfer from the UK Government. So in particular, something like Scottish Child Payment, where that's explicitly the Scottish Government introducing a new benefit where there is no comparable funding from the UK Government. And we estimate that that will cost about £580 million in 2024. And therefore, the government will then have to prioritise within its overall spending envelope how it funds these additional commitments in social security, either through tax policies to try and raise additional revenues or through reallocations of funding from elsewhere in that devolved budget pot. So that hopefully gives you an overview of our economic forecasts, our social security forecasts, our tax forecasts, and the overall funding outlook. We now turn to the Q&A, and as I mentioned, if you can log into Slido and then type in that code, we'll get the questions, and I'll then share out the questions across the commissioners. So I'll stop sharing, but if you still need the code, you can get the code in your Eventbrite allocation. Okay, so I'll stop sharing just now, and we'll come to the question. Okay, so first question here is, and I'll maybe come to David if I can for you for the first question. There's a question about, do we see any impact, positive or negative, of Scottish fiscal policy on longer term trends in economic growth or productivity? So maybe, David, I can come to you about what evidence we've got on relative economic performance between Scotland and the rest of the UK.
Okay, this is not a question we've yet investigated in any great depth. We do factor into our forecasts the behavioural consequences of changes in taxes and any tax gaps between Scotland and the rest of the UK. And those forecasts are based very much on evidence coming in part from a study done by HMRC on the responses of individuals to taxes, but also on evidence from many international studies on the effects of taxes on taxable income. So we factor that in quite a lot already into our forecast. But what we haven't done yet is a systematic study of how the emerging gap between the tax position in Scotland versus that in the rest of the UK is affecting things like productivity and other elements of growth. We just don't have yet the length of data stream that we would need to investigate that systematically.
Okay, thanks, David. The The question here about the inflation, Domenico, if I can come to you on this, about the comments on Ukraine energy feeding through to part of the increase in inflation we're seeing. But a question about what evidence we've got that potentially Brexit is also having an impact, perhaps through supply chains and the like, and what evidence we've got that that is a key element into the inflation spike that we see.
Sure. Thank you, Graham. Clearly, the context in which we made this forecast has been a very unique one. The Scottish economy has been hit by multiple series of shocks, and certainly Brexit is one of those. There was the effect of the pandemic, and more recently, the impact of the Russian aggression to Ukraine, with the implications that we all know of energy prices. So clearly, while Brexit has certainly been, a factor, we are really, assessing sort of a broader mix of shocks that have hit Scotland in a very unprecedented way. Regarding the impact of inflation, clearly, again, Scotland, the Scottish economy has been hit by rising inflation, like the rest of the UK and other countries. However, we do see that in our model we have inflation obviously receding and then converging at about the 2% target in the medium term. So our view is that inflation will be stabilizing and converging towards the medium term target set by the Bank of England.
Okay, thanks, Domenico. Francis, do you want to maybe come in and say anything about Brexit and I guess any reflections on what we were seeing a couple of years ago around the potential impacts of Brexit and feeding through to the Scottish economy, and what evidence we've got now about what's been happening?
Yeah, I mean, I think it's one of the reasons we haven't talked about Brexit much is we made an adjustment to the forecast back when Brexit occurred, and up till now we really have not many reasons to change our view about the impact of Brexit on the economy. So it's sort of baked into the forecast, and it's in there, but we don't talk about it because we haven't really changed it very much. Although one area that has changed a bit, which is Brexit sort of related, is migration assumptions that we were originally anticipating a fall in flattening off of migration, but actually it's continued. And both we and the OBR are now expecting net migration, which we weren't expecting in our last forecast. So that is a change we have made, which is sort of Brexit related.
Mm-hmm. I can just say on the, when you mean that, just to explain to people what the adjustment that was made in terms of Brexit having an effect that is now in the baseline, what was that made? What was that change?
Yeah, so I think we felt, and certainly the OBR felt, that the policies of Brexit and around Brexit implied zero net migration. So we took an assumption that the ONS create, which has that built into it, that there would be no net migration. But now I think what we're seeing in the data and so both we and the OBR have now basically expect net migration. I think that's David might correct me if I got my wrong variant there, but we've gone to the central variant of the ONS rather than one that has a lower migration.
Yeah, and then I think another thing just to say as well for people is that one of the key things aside from that is what's been assumed around productivity and the big challenge that we've had in the UK and in Scotland around productivity. And we're forecasting that productivity will pick up but remain fragile, and that's one of the ways where we know from the evidence so far that Brexit potentially could have a significant impact in terms of dampening that effect, the boost in productivity. So that's in our forecast, and the challenges around access to innovation, access to market, skilled workers, etc., all have over time will have a longer term impact through a weaker rate of productivity growth. There's a couple of questions, maybe if I can come to you, David, just around pay demands and wage demands and what that might mean. So a bit of a question around industrial action disputes feeding through to the UK and Scottish economies, but then flowing into what about pay demands leading to fueling pressures and inflation. So two kind of subparts to the question, one about industrial disputes and how that might be impacting on the economy, and then the second one around, a wage price spiral and inflation and what our assumptions have been about that. You're on mute, David.
Sorry about that. Yes, let's take the first one first of all. We haven't got a lot of direct evidence of the effect of strikes per se on the level of economic activity. Clearly, to the extent that the strikes disrupt other people from going to work, etc., there can be some effects of that. But we haven't factored that into our forecasts. The big issue is about the potential impact of wage increases on inflation. Part of the reason why governments are being so resistant to granting wage increases is because of concerns that might drive up inflation, and you might get a wage price spiral taking place, which we did see back in the 70s and 80s. And we, as Graham said in his opening remarks, we haven't seen that for 30, 40 years now. And governments are really trying to avoid that. But it does have the consequence that to the extent they resist wage increases in certain sectors of the economy, you are going to see big impacts on real living standards. So there could be consequences through the effects of that on the economy that are not being factored in.
Great, thanks. There's a question here about business investment. Maybe if I could come to Francis first, and then maybe Domenico, just about what our outlook is for business investment in Scotland.
I think you've stumped me there. I haven't got the numbers in front of me, so I can't give you the chapter and verse on that one. I mean, clearly, the outlook is relatively weak in the sense that investment will, like the rest of the economy, not be doing well in the short term. But as I say, I think if you want the numbers, maybe David Stone might be the man for that. So I say I don't have them in front of me.
David, have you got? Do you want to? We can maybe follow up afterwards. If you want to, maybe. You got either numbers to hand?
Yeah, I mean, I saw this question appearing. I was anticipating.
Oh, great! Excellent.
It. So maybe just a plug as well. I think we publish all of the numbers behind our forecast on our website and what we call our supplementary tables, and it's just got heaps of information there about all the detail in our forecast. But private sector business investment has been remarkably flat in Scotland over the last couple of decades, and in our forecasts we've got it dropping off a bit over the last couple of years just with the pandemic, and then a little bit of a bounce back effect as it returns to previous levels in real terms. But overall it's sort of fairly flat and continues to be subdued as it has been over the last decade or so.
Great, excellent. Thanks, David. Okay, there's a question here which is it's a good macroeconomics essay question for an undergraduate. So in the 1980s, we used interest rates to control consumer demand inflation. Inflation is now about supply, not demand. So how do interest rates help us control inflation? So maybe Domenico, if I could ask you to pick up that one.
Yeah, that's a very important point. Typically, interest rates are used to dampen inflation expectations in the face of demand shocks. However, in this case, what Scotland and as several other economies have been experiencing is to a large extent a supply side shock. In this case, interest rates are mainly used to sort of mitigate or dampen the repercussions, the inflation repercussions from the supply side. so that, you know, so as to avoid that this might fuel into higher requests for wages, salaries, for, you know, somehow having businesses increasing their prices, and so it is more of a way of mitigating the inflationary shock rather than being a sort of perfect tool to control, to stabilize the inflationary shock.
Mm. No, thanks. Yeah, and I think one of the things where the uncertainty in our forecast is about the inflation forecast, in the sense of on the bit that is aside from the energy price spike that we've seen, is the issues in the supply chains and issues around in the labour market, and we don't know how sticky they're going to be. We don't know what the legacy effects of COVID are in terms of skill shortages and gaps, and that's potentially something which isn't just going to impact on our forecast, but particularly around the Bank of England, about the effects of those elements of inflation, how sticky some of these are over the medium to long term, and that's probably something that is going to have to watch across the UK economy. May Francis, there's a question there about inflation more broadly on the economy and the budget, and I obviously gave a broad overview about how it obviously reducing spending and pressures in portfolios and how it's feeding through to incomes, etc. But do you want to maybe just expand a bit on the effects of inflation on the economy and how it feeds through to day-to-day kind of economic life?
I mean, one point to start with, which I guess is following on what you were just saying, is, you know, this is a particularly nasty type of inflation in the sense that it's coming from imports to goods. So quite often inflation is a sort of robbing Peter to pay Paul type of situation where it's all going on within an economy, whilst this is a type of inflation where Scotland is basically being made poorer by these energy price rises. It's not, so it does have, as you saw, particularly the real disposable income numbers, that's the sort of the pain that comes from rising import prices. More generally, obviously, if inflation is not matched by rising income, then clearly there is a negative impact on the economy that we're seeing right now. But it's on the budget side, it's sort of not as negative in the sense, partly because there's been this policy to not uprate tax bands, so that's basically generated more revenue for UK and Scottish government. So inflation is in a sense has a relatively positive impact on government income, and obviously, although there's some of that goes into social security spending, in essence, this inflation has been used somewhat to generate more government revenue.
Okay, great.
Sorry,
David, do you want to come in? Yeah, David.
Just one other thing about inflation is that you mentioned in your talk that inflation had a particular impact on the people lower down the income distribution, and one reason was because they had less discretionary income. Another important reason is because they spend a higher proportion of their income on things like food and energy, and it is particularly food and energy prices that are going up here. So that's why there's been a very distributional impact of inflation, particularly down in people at the bottom of the distribution, and we shouldn't forget that.
Well, maybe David, just to build on that, there's a question there about, do we see a positive knock-on effect on the economy of the extra spending on social security? And I maybe just explain a bit about how we do our forecasts and how this all washes out in the numbers.
Okay, there are quite a number of different effects in terms of social security. There's the uprating of benefits that comes because of the level of inflation that prevails in September before the budget. And one small point to make there is that is to some extent a discretionary choice of governments as to how much they do in fact choose to uprate benefits in line with the level of inflation in September. And that could cause problems in the future if Scotland was to operate at a different rate than the rest of the UK. But on the whole, this time around, both Scotland and the rest of the UK operated benefits by the same amount or by the same rate. So that meant Scotland benefited quite a lot from increased BGAs coming through from the rest of the UK. So to some extent, Scotland could afford that uprating of social security because of what was coming from the rest of the UK. But the bit that wasn't protected was the bit you mentioned in your talk about those elements of social security that are attributable either to Scottish policy on particular benefits or to the particular way in which they've chosen to deliver things like adult disability benefit. To the extent that those are not covered through block grant adjustments, any uprating of inflation, any uprating of benefits because of inflation will have an impact on that. What we haven't checked, though, is to what extent that does have wider positive macroeconomic benefits to the economy, whether by protecting spending, again, particularly down at the bottom of the distribution, that has any positive macro effects. Francis, do you know of any work that's been done on looking at that?
There is some. I mean, it's a difficult area because any of these links are very hard to trace through. So I don't think I can add much on that. So.
Yeah, and the key point is that from a macro perspective, from our forecast, a lot of this is taken away with one hand and the other. So if you're increasing income tax rates in order to fund additional public services, that's reducing consumer spending on the people who you're taxing more, but then you're increasing government spending elsewhere. So at a macro level, at least in the short run, most of these effects tend to wash out because they're big aggregates. Then subtleties perhaps over the longer term, and this is the whole agenda around things like inclusive growth, that actually if you can improve people's life chances over the medium to long term, that leads to a more resilient and more productive economy. That's not the sort of thing that we can capture or try to capture in short 3 to 5 year forecasts, which are largely about moving big macro numbers around. But that perhaps gets me into the next question around the impact of health on the Scottish budget this decade and the knock-on effect to economic activity and disability benefit. And if it's okay, maybe Francis, I'll come to you, but then I'd like to maybe come to Michael, who can maybe give a preview of the fiscal sustainability work, which this sort of thing will come on, and which we're publishing in March. Yeah. So Francis, you first, if that's okay, and then Michael.
Yeah, I mean, this is a really important issue right now because we are seeing some sort of odd things going in the labour market, and particularly reduced participation and things like this, which we are, it suspiciously seems linked to health and other issues. So we are concerned that there may be some, longer term, really quite significant economic impact if these health issues persist. So it's an area that we're looking at quite carefully, and indeed, I think the OBR too, because it has been a somewhat surprising longer term effect after the pandemic in terms of how the labour market is performing.
Yeah, and maybe David, before I come to Michael, just quickly, there was some stuff that, particularly around PIP, wasn't there, in terms of changes in the forecast at the UK, in terms of a significant uplift at the OBR, and that feeds through. Do you want to maybe explain a wee bit more about that?
Yeah. One of the interesting things we observed, and the OBR did as well, is there has been a much higher uptake of PIP or disability benefits than we've been anticipating. And we think that's due to 3 separate effects. One is the effect of long COVID, that people have been just a lot iller for longer, and that's created an increase in the number of people with disabilities. But a second important effect is through the cost of living crisis, and that has 2 effects. One is it causes people to apply for benefits because they're just desperate to get any sources of cash that they can, so they will apply for benefits and will sometimes be more successful in getting those benefits. But the other effect that the cost of living crisis is having is on mental health. And mental health is one of the big drivers of the uptake of benefits. Around 40% of benefits, disability benefits, are due to mental health issues. So this is having an impact as well. But we think the other thing that's going on at work here is the effects of the lengthening NHS waiting lists, that because people are finding it very difficult to get access to treatment, that means that mild disabilities are turning into more serious disabilities, which they then become eligible for disability benefits. So it goes back to the point that Francis was talking about before, that lack of spending on health does have significant effects elsewhere on the economy through the fact of the number of people who are disabled and therefore claiming benefits.
Mm-hmm. Okay, thanks, David. Okay, so Michael, a plug for our forthcoming publication.
Thanks, Graham. Yeah, so as Graham says, in March, we're going to be publishing a fiscal sustainability report, which will provide 50-year projections for the economy in Scotland and more importantly for the outlook for public finances. Now, there'll be projections rather than forecasts, so there's a bit more uncertainty, but the main thing that we're looking to capture in there is what the impact of population projections and the principal sort of driver that we think will be happening there is the aging of the population. And then with the population aging, that then flows through and has impacts both on things like social security spending, because particularly the disability benefits are the biggest component of what's been devolved, and then expenditure on disability benefits increases with an older population, and then also in terms of the demand on health spending, because as people get older, they have more conditions that need treated, so then health spending is expected to go up as well. So alongside that, we see with the aging population, there'll be increasing demand on public spending, and then on the same side, we'll be looking at the impacts on the labour market of aging population. If you have sort of fewer working age people, then obviously that flows through to an impact on labour force levels, and then further onwards into the economic performance and into tax revenues as well. So that sort of we'll be pulling all those together to give sort of an overview of what the outlook is over 50 years for the Scottish public finances. And as we've said, that will be published in March this year.
Great, thanks, Michael. So there's a question there just about, will the Scottish Government have to keep increasing tax rates to maintain the income tax net position? That's probably not a policy. That's probably not a question that we can really comment on explicitly, directly, in the sense that that's obviously a decision for the Scottish Government to make in that context. The only point I would make is that the importance of that net tax position being crucially two issues. So one is what the government are doing on tax rates, but crucially the tax base and how your tax base is growing relative to the rest of the UK. And you can get that net tax position positive or more positive or less negative, not just by increasing tax rates, but also by growing the economy too. And that balance is one of the key dynamics inherent in this framework that the government needs to think about. There's a question here about behavioural change explicitly linked to council tax, but I'm not entirely sure that council tax well, we don't forecast council tax as the first thing. We probably wouldn't change too much in terms of behavioural response to income tax, but I know, Francis, this is your pet project. You love behavioural change on tax, so maybe I could come to you to give maybe a slightly more coherent answer than I just did. So
I don't know about coherence, but maybe more passionate. So yeah, it's obviously a really interesting and important area, because there is this possibility of internal migration, which you get when you're talking about a country as a whole, with sort of less porous borders. So what we definitely have behavioural effects for the taxes that we forecast. So particularly, obviously, income tax, we've already factored in behavioural impacts for the tax changes that have happened. So that's very much an area we're looking at and we continue to look at, because it is a new area that we're still collecting evidence on. And we as Graham mentioned, we looked a lot of international evidence to try and guide us to how internal migration might be important. But we're still really examining that evidence because it's still early days. In terms of the council taxes, I think I'm not quite sure how we would figure that out. I guess it is true that if there was a significant difference in council taxes across Scotland and the rest of the UK, there might be a behavioural impact, but we haven't factored such a thing in.
Okay, great. And as David said, actually in the report, in the annex, there's a really good discussion of the difference between what we'd call static effects, which are how much is potentially raised just from a mechanical change in rates by number of taxpayers, and then the behavioural responses there, and you can see the assumptions we were making about how people potentially respond to that. And I guess that gets to the final one of the final questions that we have here about, do your income tax forecasts include behavioural responses? Yes, we do, and there's an annex there which explains what we do, and they're particularly significant at the top end of the threshold. So we've literally got 2 minutes left, so we will get the final question done if the answer could be relatively short. And it's just asking for a bit of information about the difference between economic performance between Scotland and the rest of the UK when you account for London in there as being almost like an outlier in the UK context. So maybe Domenico, if I could maybe come to you for that one, and this will be us coming to an end.
Yeah, sure. I mean, we have not really focused on London being sort of the driver of the differential performance between Scotland and the rest of the UK. However, what we have seen is that moving forward, we would expect less of a gap in the performance of the financial services sector in Scotland vis-a-vis that of the rest of the UK. So this is certainly something that we would be able to say.
Yeah, and I think the general point is there's lots of discussions about the unbalanced nature of the UK economy and the importance of the UK, so the importance of London in the UK economy and driving the numbers. But the way this framework was set up was it was Scotland and the rest of the UK with London in there, not Scotland and the rest of the UK excluding London. So things like house price performance, things like earnings growth, London's in there, and that means that's why it's so important, still remains important in the context of what we do. So just to say that's us come to the end, and we managed to get through all the questions. So thank you to the colleagues for their really short answers, but succinct answers and helpful answers that meant as we got through the questions. Huge thanks to everybody joining us for today. This was being recorded, so it will go online later on this week. As Michael mentioned, we have got our fiscal sustainability report coming out in March. So please do look out for that. And there'll be another webinar explaining and discussing everything that we're doing on that. And if it just leaves it for me to say thank you so much for joining. Thank you for your continued interest in the work of the Fiscal Commission. And hopefully at some point we'll be able to do one of these in person very soon. So good to see everybody, and thanks very much for joining us.
Thank you.